The Affordable Care Act is the nation's health reform law that was enacted in March of 2010. The law's primary aim is to reform both our private and public health insurance systems in order to expand coverage to 25 million Americans by the year 2023. This piece of legislation has touched almost every American in one way or another, either through our health insurance coverage or through our tax returns. The 2014 tax season was the first time that taxpayers experienced the financial consequences of the individual mandate or the penalty, and this brought additional paperwork and a few unpleasant surprises to some taxpayers. Under the Affordable Care Act, individuals, along with the federal and state governments, insurers, and employers, all share the responsibility for health coverage. The individual shared responsibility provision requires individuals and each member of the family to either have minimum essential coverage, or MEC, or have an exemption from the responsibility to have MEC, or make a shared responsibility payment, sometimes called the penalty, when the individual income tax return is filed. Beginning back on January the 1st, 2014 through today, individuals are required to maintain minimum essential coverage for themselves and their dependents through coverage under a government-sponsored program such as Medicare or Medicaid, an eligible employer-sponsored plan, a plan in the individual market, federal or state marketplace or exchange, or a grandfathered health plan or other health benefits coverage specified by Health and Human Services. Some tips for preparing a tax return. You want to confirm all persons listed on the return, including the taxpayer, spouse, qualifying dependent children, and any qualified dependent relatives, all have health insurance. This is known as the tax family for calculating the individual shared responsibility payment. For example, the taxpayer can be covered by his employer, the spouse, her employer, the dependent children covered by one or both of the parent's employer's plans, and the other dependent relatives can be covered through the marketplace or some other government-sponsored plan. Due to the complexity of the law and the lack of guidance regarding tax preparer due diligence, we suggest discussing with your client how each member of the tax family obtained coverage and documenting this in your work papers. Each individual must have minimum essential health care coverage, qualify for an exemption, or pay a penalty. Again, the individual shared responsibility payment. As far as employers with at least 50 full-time employees, including full-time equivalents, must offer affordable minimum essential coverage. If at least one of its full-time employees receives a premium tax credit, the employer may be subject to a penalty. This is called the Employer Shared Responsibility Payment. Both of these, individual and employer, are part of the Affordable Care Act mandates. The definition of a full-time employee. A full-time employee must average at least 30 hours per week for a calendar month or 130 service hours in a calendar month. A full-time equivalent employee, or FTE, is a combination of employees, each of whom is not treated as a full-time employee, but in combination are counted as the equivalent of a full-time employee. An applicable large employer, or ALE, is an employer that employed an average of at least 50 full-time employees during the preceding calendar year. ACA reporting, as you can see, is a moving target. Now recall that for the majority of tax filers, the changes only meant checking a box to indicate that they had health coverage during 2016. But some of those who signed up for Obamacare had to take some additional steps when filing their tax return. Consumers who signed up for health care through our marketplace or exchange received or will receive a new form, the 1095-A. This is needed for filing the federal tax return. On the 1095-A, the taxpayer is asked to figure out whether he or she received the correct amount of financial assistance, whether he or she is subject to a penalty, and whether he or she can claim an exemption from the mandate. If the Form 1095-A is misplaced, the taxpayer can obtain a duplicate copy from the exchange website. In order to obtain this copy, the taxpayer must have a marketplace account. You need to communicate to your clients the importance of safeguarding the original 1095-A as well as locating their account registration information for the exchange to avoid filing delays. Taxpayers need the 1095-A to file the Premium Tax Credit Form, which is Form 8962. The government has been providing financial assistance to some Americans in order to lower the monthly cost of health insurance on an advanced basis. These credits have been applied directly to monthly health insurance premiums. However, since the tax credit is determined based on an estimate of household income, it needs to be reconciled, taking into account the actual household income when the taxpayer files the tax return. So, a taxpayer may owe back money if he or she underestimated income, which would reduce a refund, while it could increase a refund if the taxpayer overestimated income. Premium tax credits can be paid to the insurer in advance in order to lower the monthly premium on a marketplace plan, or they can be adjusted on the tax return. Tax credits are based on income and available to folks making between 100 and 400% of the federal poverty level. 2016, this was between $12,060 to $48,240 for an individual, and between $24,600 to $98,400 for a family of four. When a taxpayer enrolls in a marketplace health insurance plan with financial assistance, he or she will have two options. First, get it now. The taxpayer can elect to have the health insurance company apply all or some of the estimated tax credit to the monthly insurance premium. Or second, get it later. The taxpayer can claim the tax credit when the federal income tax return is filed. If income or family size changes throughout the year, it may impact the premium tax credit. Changes need to be reported to the health insurance exchange so they may adjust the premium amount accordingly. Failing to do so may result in a balance due when filing taxes if the income increased or family size decreased. If the income decreases or the family size increases and the taxpayer fails to report it, he or she may receive a refund. In general, a person may be eligible for the premium tax credit if he or she meets all of the following: bought health insurance through the marketplace or the exchange, is ineligible for coverage through an employer or government plan, is within certain income limits, and does not file a married filing separate tax return except for certain circumstances, and cannot be claimed as a dependent by another person. For example, according to the Marketplace Exchange, John is eligible for a premium tax credit of $3,552 a year. During the open enrollment period, he chose to purchase the second lowest cost silver plan, which is the benchmark plan for the upcoming year. This has an annual cost of $5,000. He decided to take the premium tax credit in advance, which means that the IRS will send a monthly payment of $296, which is $35.52, his premium tax credit, divided by 12. This will be sent directly to his health insurer. This brings down John's portion of the health insurance premium from $417 to $121 per month, which he will pay directly to the insurer. A person could have elected to have advance payments of the tax credit sent directly to his or her insurer during 2016, or wait to claim the credit when he or she files a tax return in 2017. If advance payments are sent to the insurer, the payments will have to be reconciled on the 2016 tax return, again, which will be filed in 2017. The amount of the advance premium tax credits that people receive is based on an estimate of the income the household expects for the year. The final amount of the credit is based on actual income as reported on the tax return for the year the advance payment was received. This means that people whose income for the year is higher than they previously estimated could conceivably have to pay back some or even all of the advance payments that they received. On the other hand, people whose income ends up lower than estimated could get a refund when they file their taxes. How will your client claim the credit? If your client receives advance credit payments or plans to claim the premium tax credit, he or she must file a tax return, a federal income tax return, for that year. If your client chooses to get advance payments, when your client files his or her 2016 tax return in 2017, the total advance payments received during the year will be subtracted from the amount of the premium tax credit calculated on the tax return. If the premium tax credit computed on the return is more than the advance payments made during the year, then the difference will increase the refund or lower any amount of tax owed. If the premium tax credit is greater than the advance payments, then this will equal more refund or less of a balance due. If your client chooses to get the credit later at tax filing time, he or she will claim the full amount of the premium tax credit when they file their 2016 return in 2017. This will either increase the refund or lower any balance due. If the advance credit payments are more than the premium tax credit, the difference will increase the amount owed and result in either a smaller refund or a balance due. Advance credit payments greater than the premium tax credit means your client will get a smaller refund or more tax owed. If a person is already receiving advance payments of the credit, nothing needs to be done at this time unless there is a change in circumstance such as income, marital status, or family size changes. As we mentioned before, these life changes need to be reported to the health insurance marketplace as soon as possible. If the taxpayer can afford health insurance but chooses not to buy it, he or she must have a health coverage exemption or pay a fee. The fee is sometimes called the penalty, fine, individual responsibility payment, or the individual mandate. This penalty is the higher amount between a flat fee penalty and a percentage penalty. As a tax preparer, you should calculate the penalty for any tax family member who does not have minimum essential coverage or a family member who does not qualify for an exemption. The fee for not having coverage in 2016, if your clients don't have coverage in 2016, they'll pay the higher of these two amounts. 2.5% of yearly household income. Only the amount of income above the tax filing threshold, which is about $10,350 for an individual, is used to calculate the penalty. The maximum penalty is the national average premium for a bronze plan, or $695 per person for the year, $347.50 per child under 18. The maximum penalty per family using this method, $2,085. Your clients will pay the fee on the federal income tax return filed for the year that they don't have coverage. Most people file their 2016 returns in early 2017. What happens if your clients don't pay the fee? The IRS will hold back the amount of the fee from any future tax refunds. There are no liens, levies, or criminal penalties for failing to pay the fee. A taxpayer can file for exemptions from the individual responsibility payment. This penalty can be lowered or eliminated if the taxpayer qualifies for one of the exemptions based on financial hardships, religious affiliations, or gaps in coverage, among others. The taxpayer may need to apply for some exemptions and receive approval. Exemptions from the marketplace are obtained online at healthcare.gov/exemptions. A unique 9-digit code per exemption per taxpayer or household will be assigned. The taxpayer will report this exemption code on Form 8965, Health Coverage Exemption. Some examples of IRS exemptions include, but are not limited to, short coverage gap up to 90 days, household income below the return filing threshold, Medicare or Medicaid or a grandfathered plan, U.S. citizens while bona fide residents of a foreign country or U.S. territory. Coverage is unaffordable. If the lowest price coverage exceeds 8% of household income, it's deemed unaffordable. Members of federally recognized Indian tribes or members of a healthcare sharing ministry. Members of certain religious sects, objections to insurance, Social Security, and Medicare. Incarceration. Details can be found at irs.gov/UAC/ACA Individual Shared Responsibility Provision Exemptions. There are some other new forms that we've been exposed to on our tax returns as a result of the Affordable Care Act. Another is the 1095-B. Taxpayers will need the 1095-B form to report and verify on their tax return that the tax family had qualifying health coverage. It's basically proof that the tax family had the type of coverage required by the ACA. The ACA requires certain employers to offer health insurance coverage to full-time employees and their dependents. These employers must send an annual statement, a Form 1095-C, to all employees who are eligible for coverage. This statement describes the insurance available to them. The relationship between the 1095-C and the 1095-B goes something like this. The 1095-C describes the coverage made available to an employee. The 1095-B provides the details about an employee's actual coverage, including who in the worker's family was covered. The 1095-B is sent out by the insurance provider. The 1095-C is sent out by the employer. A taxpayer must complete the Form 8962 and file it with his or her tax return in order to claim the premium tax credit. This form must also be filed if he or she received premium assistance through advance credit payments. Remember this one from last year? The individual mandate exemptions will again be claimed on the Form 8965, Health Coverage Exemptions. Some new lines were added to the 1040, also as a result of the Affordable Care Act. On the 2016 Form 1040, line 46 reports any advance premium tax credit repayment from the Form 8962. This amount adds to the taxes owed. Line 61 of the 2016 1040 incorporates the individual mandate. Line 69 of the 2016 Form 1040 reports a premium tax credit from the Form 8962. So you can see here the Form 8962 could possibly flow to one or another of the lines on the 1040. We encourage you to stay informed. Under our system of government, laws are certainly not written in stone. Congress can modify or repeal them, the President can refuse to enforce them, and the courts can strike them down. Election results can change the nature and the implementation of laws. Like any other law after its enactment, the Affordable Care Act exists in a fluid state. It's possible that new developments will cause the law to mutate into something much different from what it is today. In summary, the Affordable Care Act's individual shared responsibility provision requires individuals and each member of the family to either have minimum essential coverage or have an exemption from the responsibility to have minimum essential coverage, or make a shared responsibility payment, sometimes called the penalty, when the individual income tax return is filed. Individuals are required to maintain MEC for themselves and their dependents through coverage under a government-sponsored program such as Medicare or Medicaid, an eligible employer-sponsored plan, a plan in the individual market, which is the federal or state marketplace or exchange, or a grandfathered health plan or other health benefits coverage specified by Health and Human Services. Premium tax credits can be paid to the insurer in advance in order to lower the monthly premium on a marketplace plan, or they can be adjusted on the tax return. In general, to be eligible for the premium tax credit, a taxpayer must purchase health insurance through the marketplace, sometimes called the exchange. If your client receives advance credit payments or plans to claim the premium tax credit, then he or she must file a federal income tax return for that year. Form 1095-A is used to report certain information to the IRS about individuals who enroll in a qualified health plan through the health insurance marketplace. Use Form 8962 to figure the amount of premium tax credit and reconcile it with advance payment of the premium tax credit. Use Form 8965 to report a coverage exemption granted by the marketplace, or to claim a coverage exemption on the tax return. Now let's look at some review questions.